Okay, I think you can see, right?
Yes, yes.
Okay, so our presentation reviews the impact of ESG on the economy and financial risk. As Professor Afshin said, this work is a combination of the research from a systematic literature review based on the research work carried out in a team, including me, Ana Beatriz Gomes, Débora Nascimento, Rui Prata, and Professor Afshin as our supervisor. We will therefore present the results of our systematic literature review with 4 approaches to ESG performance in economics and finance. Here is the lineup for the next few minutes. We'll present the 4 different approaches. So there are 3 essential components to assess a company's sustainability and social impact. First, we have the environmental criteria that helps stakeholders understand the organization's impact on the climate, like its greenhouse emissions, water and energy consumption, carbon footprint, and resource conservation, for example. In other words, this pillar focuses on a company's commitment to minimize its negative impact on the environment. Second, we have the social criteria that examines an organization's social impact. It seeks understanding how well leadership manages relationships with the employees, customers, stakeholders, and communities in general. And finally, we have the governance criteria that considers the management and supervision of a company. It refers to the governance factors of decision-making from sovereign policymaking to the distribution of rights and responsibilities among different participants in corporations. Our article will discuss the fundamental intersection between ESG, risk management, sustainability, and the banking sector. Some recent findings highlight banks' role in guiding our global economy towards sustainability by influencing investment choices and establishing a deep link between ESG performance. Looking deeper into ESG, it was found that a good performance in these areas not only promises better access to credit for companies, but also serves as a catalyst for shaping investment scenarios. As we explore this relationship between ESG and economic growth, a significant correlation emerges, drawing attention to the profound impact of sustainability improvements on global economic prosperity. Moving on to an equally important area, the corruption risk management and socially responsible practices within financial institutions, there are also some interesting ideas. It turns out that financial institutions are not just stakeholders in economic systems, they are also very important players in reducing corruption concerns and promoting socially responsible behavior. The method used for this literature review was based on a search on Scopus, Web of Science, and Google Scholar, with the aim of finding the most important articles related to the topic. And we'll start now with the first approach that focuses on the influence of ESG measures on the creditworthiness of a debtor. The methodology employed for assessing the effect of ESG measures on debtors' creditworthiness will involve an examination of the impact of ESG on credit ratings. Firstly, it was carried out a search on Scopus and Web of Science, from which the most important articles were selected, resulting in 238 articles for content analysis. And here we also present you the combination of keywords used for this search. We have keywords such as ESG, credit ratings, banking, creditworthiness, and financial performance. Then the voice viewer was used to create the diagram with the authors and keywords occurrence. Here we have the density visualization of the 32 leader authors who published at least two papers related to the influence of ESG measures on creditworthiness of a debtor. And here is the visual representation of the keywords of currency. We can see some of the main keywords such as ESG, financial performance, sustainability, environmental, credit ratings, and so on. The topic of ESG is being discussed more and more, as we can see by these trends of the topic according to the Google Trends tool. A clear positive trend can be observed in the popularity of the topic over time, and it proves that environmental, social, and governance factors are becoming increasingly well-known, and the business and investment community considers them to be a subject of interest. I'll show you now some tables. The first table summarizes the top 10 articles considered in this analysis, with the journals where it was published, the citations and citations per year. This one summarizes all the journals where the articles reviewed were published, with the top one being the Business Strategy and the Environment Journal. And finally, we present here some articles presented in conferences that dealt with this theme over the years. Finally, I'll present you in these slides the findings of some of the authors presented. We'll start with the findings by Broggie et al. In 2022 that states that ESG plays a pivotal role in shaping expected loss, impacting the probability of default, exposure to default, and loss given default. It's also interesting that as ESG ratings improve, there's a tangible reduction in the likelihood of a company default, according to Lee et al. Study. This study also states that as the term structure increases, the mitigation effect of ESG on credit default becomes even more pronounced. Another study, this time conducted in 2019, stated that ESG performance and the individual components performance has a positive impact on creditworthiness. And in line with this, Zhang's findings showed that firms with better ESG ratings not only enhance their credit approval chances, but also reduce exposure to collateral obligations. And finally, it is noteworthy that a significant majority of the studies reflect positive conclusions and facing the profound link between good ESG performance and better company financial performance. As we reflect on these ideas, we are led to consider how the integration of ESG considerations can not only mitigate risks, but also boost the success of companies. Moving on to the last articles considered in this analysis, we'll start with Eber et al. Publications. In this field of credit risk management, the adoption of environmental considerations is increasingly no longer just a choice. It is very important and imperative. According to Weber et al., it states that environmental risks influence every stage of the credit risk management process, making their inclusion essential to a more comprehensive risk mitigation strategy. Also pointed out by Weber et al., a substantial improvement in the accuracy of risk classification arises when sustainability criteria is integrated into the credit risk management practices. Now turning on our focus to the impact of each ESG factor, it's interesting to note that among them, the environmental measures stand out as the most significant according to the Schodnicka-Jaworska study. And now, focusing on more on financial performance, an interesting finding reveals that the return on assets metric rises positively when influenced by ESG performance. This not only underlines the financial implications of integrating ESG measures into the financial process, but also raises interesting questions about the wider impact on business operations. Vettel's research sheds light also on the comparative influence of environmental, social, and governance performance. And interestingly, the governance performance emerges as the heavyweight, exerting the most substantial influence on financial performance among the three different ESG components. Now we'll start the second approach. Here we have a table summarizing the articles with important findings regarding the impact of ESG on economic growth. Addressing environmental, social, and governance practices is crucial for ensuring long-term economic sustainability. And ESG aspects impact the stability and resilience of economies, influencing their ability to confront future challenges such as climate change, social and economic crises, and resource scarcity. A recent study conducted by Young et al. Found that the positive economic effect of country-level sustainability performance is more pronounced in countries with strong incentives to improve ESG performance, but less economic reliance on natural resources, and for regulatory, legal, financial, and cultural environments that are conducive to ESG policy implementation. On the other hand, ESG performance is higher in countries with less political stability, and corporate governance is higher in places with better regulatory quality. Firm profitability influences how country-level governance factors affect companies' ESG performance. So practically, it suggests that governments can encourage better corporate governance, leading to increased sustainability efforts without always needing specific regulations for environmental and social performance. Moving forward, here we present findings related to each ESG component. Starting with the environmental pillar, we have that the carbon dioxide emissions, which are recognized, as we know, as a primary contributor to the phenomenon of global warming, manifest a statistically noteworthy long-term co-integration with economic growth. According to the study conducted by Onofre et al., it is disclosed that on average, a 1% change in gross domestic product corresponds to a 0.072 change in CO2 emissions. Regarding the impacts on social practices, higher income levels lead to an increased demand for environmental protection, emphasizing the importance of designing environmental policies capable of reducing emissions during periods of economic growth. And finally, in terms of government measures, country-specific factors can provide more stable performance factors for companies adopting ESG and help companies focus on more relevant ESG issues. We finish the analysis of ESG relationship with economic growth with the findings of Park et al. Based on a study that has conducted a survey gathering opinions from investors considering specific factors for each country and common global factors, it was concluded that country-specific factors can provide more stable performance predictions for companies adopting ESG and help them focus more on the relevant ESG issues. This way, they expect to have some implications for corporate management, such as having an established framework that gives companies a clear direction for managing sustainability issues. Having specific policies for each country model will make it easier for companies to adopt ESG disclosures and practices. And finally, participants in the supply chain and consumers can benefit from an ESG framework tailored specifically to the country's specificities. Moving on to our third approach, which a main research question is, how do corruption risk management strategies contribute to the United Nations Sustainable Development Goals? We know that risk management holds a crucial significance in the banking and insurance sectors due to their vulnerability to various dangers and facing the need for effective risk management in maintaining balance among financial uncertainty and potential loss. Corruption, which is identified as a significant impediment to global economic development, can result in financial fraudulent conduct and a resource misallocation, posing a threat to financial stability. This established corruption, which hinders the realization of the United Nations SDG for a peaceful and inclusive society, needs proactive measures. So therefore, financial institutions, recognizing their key role, engage in corruption risk management through robust internal controls, due diligence, and anti-corruption policies, contributing to the advancement of SDG and sustainable development. Here we summarize some of the findings regarding corruption risk management. Firstly, corruption risk, which is defined by Transparency International, is the potential probability that corruption may occur and the possible costs it might cause. There are three main categories of corruption determinants: economic, political, and cultural. It is also very important to assume anti-corruption has a part of sustainable corporate governance and environmental, social, and governance issues. And finally, companies can improve their capacity to resist corruption by using technology, applying internal controls, and complying with the legal requirements of anti-corruption laws through regular policy reviews and updates. The results of this literature review show regarding social impact responsibility that it is very important to, firstly, build trust and moral values, to promote equity and fairness, justice, to protect the vulnerable, and finally, to promote economic development and, of course, attract investment. Sustainable finance is interdisciplinary in nature, with contributions from authors from various fields such as economics, environmental sciences, and business, which provide essential information for the discourse on the lasting viability of financial practices. As Mark Carney, the former governor of the Bank of England, states, sustainable finance is characterized not by sacrificing returns, but by understanding and skillfully managing risks. The corruption risk management practices that can improve the sustainability of financial practices by contributing to a stronger and more reliable institution can be such as the transparency and accountability, the environment and social responsibility, the risk management, and compliance and governance. Now, starting with our last approach, as we all know, we are currently facing a scenario in which all countries must take measures to preserve the world and combat climate change. Since the beginning of the 21st century, sustainable development has been a major concern on a global scale, and this increased concern was triggered by the measures and goals imposed by the United Nations with the Sustainable Development Goals, SDGs. The banking sector can be considered as a way of implementing sustainable measures. We all know the term green banking, which describes how banks can reach their full potential by taking on responsibility, being socially conscious, and most importantly, lending money to borrowers who behave well in terms of the environment, society, and government. Here we present the main findings regarding environmental risk management and sustainability in the banking sector. ESG considerations exhibit a favorable impact on corporate profitability with a more pronounced effect on larger businesses. A growing number of companies are intensifying their commitment to ESG activities, and this surge in dedication is driven by a desire to be acknowledged as socially responsible. And notably, the popularity of ESG is not confined just to developed economies. It also holds substantial implications in capital markets of emerging economies. Most of the studies reviewed, both in this approach and in the first approach presented today, can confirm that credit ratings are often positively affected by ESG factors. According to a study conducted by Kim and Lee in 2021, surprisingly, the environmental score has a negative impact on credit ratings, being the social aspect the one with most significant impacts. Despite this finding, we have previously noted that other studies conducted within this area of research have come to different conclusions regarding which ESG component has the greatest impact on financial performance and credit ratings. And these not unanimous findings can be derived from the different nature of the data used, such as different allocation, different industry, different ranges of time, and so on. As we know, a circular economy aims to create a regenerative system that benefits businesses, society, and the environment by reducing waste, conserving resources, and promoting sustainability. This concept falls within the scope of implementing ESG measures. The circular economy has become a major force behind the advancement of sustainability. Businesses operating in this circular economy have made major contributions to employment and to the gross domestic product. Digital e-businesses must not only take care of the sustainable growth of the circular economy, but must also focus on environmental problems. The growth of these businesses in the circular economy holds promise for social and environmental benefits in addition to financial gains. Goals such as the Sustainable Development Goals and climate action plans can be considered a good initial target for promoting sustainability in companies.
Catarina, sorry,
Yes.
more 1 minute because we have no more time.
Okay. So
Okay, thank you.
let me just pass to the conclusions that I need 1 more minute. So according to what we have done till now, for the environmental risk management and sustainability in the banking sector, the findings suggest that banks and financial institutions can play a fundamental role in transitioning to a more sustainable economy with an influence on investment choices and making a relationship between ESG performance and financial risk management, for example, as we have seen through credit ratings. Additionally, we have seen that a good ESG performance could give better access to credit. Regarding the impact of ESG on economic growth, a significant correlation between GDP and CO2 emissions is confirmed. Country sustainability improvements are expected to have a net positive effect on economic prosperity. About corruption risk management and socially responsible practices in financial institutions, the main findings infer that financial institutions are very important in reducing corruption and fostering socially responsible behavior. These conclusions presented previously led to identifying some research gaps in the field, such as which ESG pillar impacts credit ratings, how ESG can affect economic growth, how to conduct corruption risk management strategies, and what measures financial institutions should take to promote sustainability without harming the sector. These questions show the long way ahead for research works on ESG effects on the economy and financial risk management, especially in the era of emerging technologies, AI, and big data. And that's all. Sorry for exceeding my time. Thank you a lot.
Okay. Thank you, Catarina. Thank you, Professor Afshin.